Hello fellow traders. Today we're going to dive deep into how to analyze multiple time frames and show you how they can transform your trading approach from guesswork to strategic decision making. I'll show you how professional traders stack the odds in their favor by aligning signals across different time horizons, just like a championship coach developing winning plays to see the whole field. Today we're going to get into multi-time frame analysis, finding higher probability setups by pajama trading. Let's get into it. Why multi-frame analysis? Single time frame analysis severely limits your market perspective and significantly increases your exposure to false signals. When you align trend direction and price action across multiple time frames, you dramatically boost your confidence and your trade quality. This approach helps you identify true support and resistance zones while optimizing your timing for entries and exits. Trading is just one time frame, like a game and watching with just one player. You miss the bigger picture. The weekly chart reveals a season-long campaign. The hourly chart shows today's game plan, and the 3-minute chart shows you the exact moment to execute. When all three align, that's when the magic happens in your trading account. Understanding the 3 time frames. The weekly time frame serves as your strategic overview, revealing the big picture trend, support or major support resistance zones, institutional interest. The hourly time frame functions as your tactical setup chart, showing consolidation patterns, volatility shifts, and potential breakout zones. The 3-minute time frame becomes your execution tool, providing precise entry timing, volume confirmation, and momentum validation. Think of these time frames as your coaching hierarchy. The weekly chart is your season strategy. Where is meta heading over the next 3 months? The hourly chart is your game plan. What's happening today and this week? The 3-minute chart is your play-by-play execution. Exactly. When do we make our move? Each time frame answers a different question in your trading process. Case study, meta platforms. Let's break down this meta trade step by step. The weekly chart shows us a powerful uptrend from $87 to $740. That's our primary trend direction. Notice the pullback to $549, which might scare a single time frame trader. But look at the hourly chart, perfectly consolidating between $512 and $582. Before the decisive breakout, then the 3-minute chart gives us the perfect entry at the moment of $538.60, as the price confirms the breakout with increasing volume. This is textbook multi-time frame alignment in action. The weekly chart reveals Meta's impressive journey from 87 in 2021 to peak 740, followed by a significant pullback to 549, all while maintaining its long-term uptrend. The hourly chart displays a textbook consolidation between 512 and 582, culminating in a powerful breakout to 580, supported by substantial volume. The 3-minute chart captures the precise breakout moment when the volume surged, offering an ideal entry point with minimal risk. Multi-time frame trading process. First, confirm the dominant trend on the weekly chart to establish your directional bias. Next, identify consolidation setup zones on the hourly chart where the price is deciding its next move. Then time your entry precisely using the 3-minute chart, watching for volume confirmation and momentum. Always validate price moves with volume across all time frames to ensure institutional participation. Finally, set your stop loss based on the volatility profile of the lowest time frame to manage risk effectively. This process is your game plan for every trade. Start with the weekly chart to determine if you should be looking for longs or shorts. Move to the hourly chart to find where the price is setting up within that larger trend. Then use the 3-minute chart to pinpoint your entry for maximum reward with minimum risk. Follow this process religiously. It's what separates professional traders from the amateurs. common pitfalls and how to avoid them. Ignoring the higher time frame trend often leads to fighting the market and diminishing returns. Jumping prematurely into trades based solely on the lowest time frame creates unnecessary losses. Overtrading out of impatience or FOMO, fear of missing out, damages your account and psychology. Neglecting volume analysis removes a critical confirmation tool from your arsenal. Abandoning your process during drawdowns prevents you from capturing big moves. Even professional traders fall for these traps. The most common mistake I see is traders ignoring the weekly trend and wondering why their hourly setups keep failing. Another is jumping into trades too early because the 3-minute chart looks good, without confirming the setup with the higher time frames. Remember, patience isn't just a virtue in trading, it's a requirement for success. Your winning formula. Multi-Timeframe analysis is your secret weapon. It gives you a full view of the market's game plan, not just a highlight reel. When you line the weekly, hourly, and 3-minute charts and confirm the volume, you put the odds in your favor, just like a great team stacks the field. But remember, even the best playbook needs execution. Patience and discipline are your training. Respect the process, win or lose, and you'll stay in the game for the long haul. Thanks again for watching.